Traders, how are you? Welcome to the latest episode of the Institutional Weekly. Got some exciting stuff for you today. Really amazing episode. Very important episode with kind of what's been going on with the FOMC this week. Kind of a shift in gears. So we're going to get right stuck into it. You can see a slightly different layout today. I'll briefly show you what I've been doing throughout the week, my P&L in September. We're going to get straight into it. As you can see, going to talk about the FOMC, Evergrande in the news this week. Really important topics that have been driving the market recently. Before we get going, welcome. If you're new to the channel or new to these institutional weeklies, I spent many years working in the institutional industry, and I'm not talking back office, I'm talking at the front line, right at the front, dealing with some of the biggest hedge funds and investors, central banks, real money funds in the world. This is the stuff they're looking at. So this is the video for you. Let's get going. So as I said, I'll just quickly show you what I've been doing. You can see here Friday, didn't really trade on Friday. It was quite a rotational day. The market was just digesting, obviously the FOMC statement. I'd already kind of had the reaction to it on Thursday. I wasn't around. I took a small little trade just towards the end of the day. Kind of missed the move up on Thursday, which we're going to talk about in a second. Wednesday I didn't trade. Tuesday I didn't trade, and Monday I had quite a decent day on Monday. So a bit of a varied week for me, partly because I wasn't around as much as I wanted to be, plus there's been a pickup in volatility. So just to put things into perspective, I'll show you my P&L for the week. So kind of the stuff no one really shows. So obviously I've shown you all my fills as well. You can see only 2 days trading over the last week. So about 3.5K on the Monday and what is that? About $900 on Thursday night. So about 4.5K for the week. So in September, about 18K. Cash. Obviously I trade my own money, and in fact let me just go into the details, because no one shows this level of detail. They're all showing these ridiculous single screenshots which actually belong in a dustbin, right? They don't mean anything, right? My grandmother can have a winning trade. What does that mean? You want to look at things over a period. Here you can see the entire month, the deep statistics. My MAE has been slightly, in fact, quite a bit larger than I would have liked. But then my average daily gain has obviously been up as well, because I haven't been trading as much this month as I wanted to. Those who follow my Instagram at NVForex will know that I've had a few things going on. But end of the day, I'm on top of things. So like I said, let's just get into it. You see my P&L for the month. Very quick rant I want to have before we get into the important stuff, because it is important. When I'm on YouTube and I'm trying to think about things to talk about and I'm researching topics, I keep seeing all this garbage about, this scalping strategy, 2-minute scalping strategy, the best 10-minute scalping strategy in the world. You've got to be careful with a lot of that. In fact, with all of it, because it's a load of rubbish. It's like going to work, right? And it's actually hilarious when you think about it. It is literally like going to work, your boss sitting you down, right, at your desk, and saying to you, right, here's a 10-minute strategy. You need to work 10 minutes a day, okay? And the rest of your career, you're going to be a superstar, okay? Literally just sit at your desk 10 minutes a day. Here's the secret strategy, and you're going to be a superstar. Complete and utter never heard so much rubbish in my life, right? And that's pretty much 90% of what I see on YouTube. What I'm obviously going to bring you today is the reality of what is going on. Like I said, when I worked in institutions, the sort of stuff we were looking at was in depth, and you need to be doing a similar amount of hard work. So let's just get everything out of the way. I kind of shown you my fills. Obviously I'm going to get this into full screen mode, so hopefully you can see that. Like I said, today we're going to be talking about the FOMC Evergrande, so let's just get on with it. So you've already seen, like I said, kind of my week, but I do like to summarize the week, as I always do. I think it's a great way. It doesn't matter what market you follow, you should have a vague idea of what equity markets have been doing, because they will obviously give you clues to all markets, crypto, forex, and commodities and so on and so forth. So generally we can see last week was a pretty solid week for the S&P. We had the sell-off the previous Friday, which continued into Monday. The reason given was the potential trouble at Evergrande, the property firm in China. As I'm going to show you, I think that wasn't necessarily the case. I think that was just used by news outlets as some reason as to why we pulled back. I actually think the market was just taking some profits off ahead of obviously the FOMC, and this just kind of was a nice headline for news outlets to use, and I'm going to show you that actually in a moment. No data of note on Tuesday, and then when the FOMC statement came out, it was very supportive. The statement, we're going to talk about that today, and basically we just saw the market rally to end only 1.8% now off the record close. So we had a really solid week last week, apart from Monday. Let's get straight into it. Now, I'm probably going to do a little bit of back and forward as I always do, but you know, obviously as I like to do, just lay out kind of the week, as said on the chart as well. No data of note here. It was all about the FOMC. We had the Evergrande, I might pronounce that wrong, but anyway, the issues with Evergrande we can see were on the Monday, and then the FOMC was the focus. Now, starting with Evergrande, I've pulled together some information here. Essentially, why has this become such an issue, or potentially, in theory, such an issue? They've got, I believe it's about $200 billion in debt, and they're doing about 100 billion in sales last year. So obviously a very large potential exposure if things were to go wrong. That's about 2% of China's GDP, I believe. They've got in terms of debt on their balance sheet. Now, I actually think that it doesn't make any sense that everyone was blaming this, because let's have a look at their share price, right? Evergrande share price has been going down basically for the last 6 months. So, you know, since July, August time, it's been collapsing anyway, right? If we look at the value of their debt as well, same sort of thing, May, June, July, it's been going down, okay? So people have known about this issue for a long period of time. So it doesn't quite make sense. The second thing is that the exposure, you know, people have been saying it could be a Lehman Brothers and Contagion and etc., etc. The difference is with Lehman Brothers, obviously the exposure to the debt was quite spread out in nature. It was global in nature. With the Evergrande group, the exposure to like foreign companies and banks, it's tiny, right? And a bunch of investment banks have come out and said, we've got very little exposure to this. So it should be quite contained within China. The Chinese government should be able to act locally, which I think is why the market kind of rallied so strongly the next day. And also, finally, let's have a look at the Chinese stock market. The MSCI here, you can see the China ETF. Basically, it's at the lows, right? It never really made new lows. You would have thought with such terrible news, you would have expected the market to make new lows. It hasn't. It's quite supported, which suggests that a lot of this was already priced in. Because like I said, there you can see, people knew about this in advance. It's already priced in, right? That's why we didn't see huge lows being made in the Chinese stock market. It also suggests to me that many investors, Chinese investors and foreign investors, are expecting the Chinese government to step in with some stimulus if things were to go really bad. So I personally think wouldn't quite go far as saying it's a non-event, but I would say it was very much overblown. And that is proven here, where you see the market then suddenly start to rally, okay? So I actually think the market was just taking some healthy profits. The Evergrande headlines were there just to give news outlets a reason as to why that might have been happening. I don't necessarily think that was a major influence. Maybe towards the end it might have stretched it out. I think on an intraday basis we're almost down 5%. You know, without this news we might have done 4%. I don't know, but ultimately it wasn't the catalyst, is my point. So yeah, that's my view on it. I don't think it's going to be a big issue going into the rest of the year. I think the market will put this aside. we'll keep an eye on it, but time to move on from it basically, and maybe focus on things that are more important, like the FOMC tapering. This was really interesting. It was kind of expected, but it's nice that it's now finally been made official. We can see the next, so this was the September FOMC meeting, very important for every single asset class in the world. I don't understand why anyone would think this stuff is not important just because they're not trading equities. It's important for everything. We can see the FOMC statements. I actually printed them out. I read them side by side. I looked at the differences. It was clear. This line was added in to the statement by the FOMC. A moderation in the pace of asset purchases may soon be warranted. Basically, that is a big signal the market is giving, the Fed is giving to the market, that at the November 2nd meeting, they will be announcing easing off of basically their loose, not necessarily completely stopping loose policy, but at least tapering off some of their asset purchases, the supportive purchases that they've been doing on their balance sheet. As I've talked about on many institutional Sundays, they're going to be paring that down. He also said during the press conference, and I think I've written it down here, he twice said that the hurdle of substantial further progress has all but been met. Okay, so basically it's going to take some disastrous economic data between now and the next meeting for them not to do this, okay, which is very unlikely. They even said in the press conference, or Jerome Powell even said, he's only looking for a decent employment rate number report between now and the next meeting. So it doesn't even have to be anything spectacular. It would have to be completely disastrous for them not to do this. So it sounds like it's going to be done. A couple of other things just to note, and why it was so supportive is, firstly, it's been signaled, right, to the market in advance. It's not going to come as a shock if it starts to actually happen, i.e. it's officially announced in November and they start to actually reduce their asset purchases of, is it 80 billion a month of treasuries and 40 billion of mortgage-backed securities. When they start to reduce that in December, once they announce it in November, it's not going to be a surprise. Number two is they did at this meeting, and that's why you see an asterisk, set out their economic projection. So they actually lowered GDP forecast for 2021. I've got it written down here, to 5.9% from 7%. And then 2022, they actually revised it up, okay, from 3.3, from 3.3, and they revised it up to 3.8, okay, which is kind of in line with what I've been saying in all the institutional Sundays, that probably the Delta variant and supply constraints are going to hit the economy. Obviously, we've seen that already in the issues with inventory build and the GDP number. So that's going to be an impact in 2021. But the positive is that it feels like a lot of that will be unwound, and demand will continue to be strong. And once those issues get sorted, i.e. COVID cases come down, inventories are allowed to build, which I've talked about many times, then we'll actually see a net benefit going into 2022. Treasury yields actually went up to their highest levels in about 3 months, which is very positive, and I'm going to talk about that, which the market took positively. So that's why the market rallied so hard, because they saw it as a positive statement. And also, Jerome Powell made a point of saying that just because we're going to be, easing our asset purchases in terms of the tapering, doesn't necessarily mean we're going to be hiking rates for some time. And they made a point of that, right, in the rhetoric that they talked about. I'm going to show you that now. In fact, you can actually see it, right? So if you look at the dot projections for the meeting, and this is the 18 members of the FOMC anonymously saying where they think interest rates will be over the next few years. Look at 2023, right? Very interesting. You've got FOMC members thinking it might be at 0. You've got FOMC members thinking it might be as high as like 1.75. Can you see the wide range? Okay. So we just don't know. Obviously, there's not going to be any rate hikes this year, potentially a couple next year, but we don't know towards the end of the year. But the reality is that, couple of key takeaways then is that the tapering process is likely to end in mid-2022, but then that doesn't mean that they're going to start raising rates. They're going to continue to be very supportive of the economy, and I think that's what the market liked, and that's why we saw this big rally, right, in all assets last week post the statement. Now, I talked about treasury yields, okay, and we're almost done. I've just got a couple more things to go over with you guys. You can see that here. Treasury yields 1.47% on the 10-year. Okay, this is the 10-year treasury. Okay, so you can see, broke resistance, been going up, and that's not a trend line, by the way. I'm just showing you the direction, and you can clearly see that the projected direction of yields is going up. And why is that important? It's important because it reflects in the treasury market that the market will be able to handle the removal of FOMC support in terms of their asset purchases. Economic growth is likely to be strong, and therefore that's reflected in higher 10-year treasury rates. And actually, I haven't talked about it here, but I haven't got it here, but actually the yield curve, right, if you look at the difference between the long end and the short end, the 10-year versus the 2-year, it has actually steepened, driven by the 10-year, right, which is generally positive for, or suggests that the market thinks economic growth will be strong next year, despite obviously this gradual removal of FOMC support that we're likely to see, although rates won't be hiked, right? It's just going to be the asset purchases. And just one final thing, you can see it here. This is the S&P equal weighted index. Obviously, normally the S&P is skewed by market capitalization. Here you can see it's equal weighted. You can see the clear correlation between 10-year government yields and the S&P equal weighted index. So the fact that yields shot up was definitely supportive for the market last week. Something I'll be keeping an eye on into the next year, the rest of the year, is obviously 10-year treasury yield. I think almost done then for a summary. Obviously, we're going to have a look at next week's calendar just very briefly. And in fact, we may as well just summarize on the calendar. So, end of the day, I don't think there's going to be that much between now and the next meeting, apart from payrolls that, at least in terms of economic data that the market will be looking at. Next week is fairly quiet. You've got final GDP and some inflation data. I'm not so sure, given the FOMC statement, now that the FOMC has finally kind of, said quite clearly that we will be starting tapering. I'm not sure how much the market's going to pay attention to much, apart from obviously the payroll number, which is the week after. So it could be more headlines driving the market. There's also a couple of final things just to be aware of is the potential government funding issue, right? Congress needs to approve by September 30th, basically, funding for the government and then raising of the debt ceiling. Something we'll probably talk about in future Institutional Sundays, along with EPS, right? Estimates, earnings growth, earnings reports really for Q3 as we head into obviously Q3 reporting season now. End of Q3, obviously into Q4, getting ready for that. So that's going to be really important. Those are going to be the risks, and therefore, as I've said all along, I think volatility will increase. I think generally the market will be quite bullish. I think we'll see what happens, but that's my stance between now and the next FOMC meeting. Gonna have some really interesting Institutional Sundays for you, just kind of looking at different takes on things, because the economic data calendar is going to be less of a focus. Now hopefully that was useful for you. You can see the summary here. I've pretty much summarized here. If all of this makes no sense to you, that's fine. Best place to start, I've put the link here, is it might be on the other side, I can't remember. Day trading for beginners. Check that video out. It's my last video. It's only 5 minutes to help you get into the sort of stuff you see here. Get you trading properly. Have a great week.